Hey everybody, make sure I'm recording first before I give a
You are.
spiel. Yeah, I'm recording. So hey everybody, welcome to another weekly recap. This is Trader Travis, my partner Prophet Peter's on the line. Before we actually officially get started, actually first disclaimer, and then I'll tell you the outline of today. Everything we're sharing, of course, is for educational, informational purposes only. This is just our opinion. As a matter of fact, I'm going to load up a conversation Peter and I just had. We do some warming up before we start these recaps. And he said something I thought was brilliant that a lot of people need to hear. So what I'm going to do is load that up first, and then we're going to drop back into our regularly scheduled recap where Peter is going to cover some concept of insurance, answer a question from a member. And then I will end with truths about wealth building, my spiel, truths about wealth building. So let me load up that video and we'll be right back. So that's why I bought it. It was like 200. I was just trying to see if I could learn anything new. And no, I was like, well, just reinforces that we had an excellent program. And it was like, if I work hard, remember going back to the t-shirt thing, if I work harder at getting people to know about our program versus getting distracted, then we could take the place of a company because we have superior education and a superior blueprint. So, I can't talk about him because he's more popular than me and he put in the effort to market himself, intelligently. And we need to do that because we really have something that can help people. So that's our mission. That's our goal. That's our ethical responsibility.
And that was, and I meant to ask you this too, because I was reading your email. I haven't watched the video yet. Your spoiler alert email where you said your profits are actually just.
Oh yeah. The bombshell. Yeah.
I haven't watched the video yet, and I'm going to probably tear it apart because I know you're always very conservative. Sometimes I think you're conservative, but I know why you do it. But at the same time, I always like to tell people he does that because he doesn't want to be like all the others that are actually lying about their returns.
Yeah.
Oh, I made a 185% return.
Yeah.
Really? For your account? Well, no, just on one trade. I'm actually down 12%, for the year. So, and they don't tell you that part. Whereas you're very conservative, so you don't fit into their mold. But I always get frustrated with you on those because you don't fit into their mold. You are completely different. And you know what? If people just followed the blueprint to the letter, like what I was telling you, Loss, if you just follow the blueprint to the letter, you don't need the spreadsheet, you don't need the videos, the weekly recaps, you don't need any of that. You just need to put your nose to the grindstone, follow the blueprint, and then you'll realize after a year, holy crap, this program's worth it. Because this is what most people, it frustrates me. I even asked this one of my golfing buddies the other day. I'm like, if I asked you, there was 3 of them, right? One of them's a real estate investor, and he was asking about our program. I sent him to the free site. And I said, well, he said to me, we were talking a little bit about returns. He asked me, and I said this, that, and the other thing. I said, but I can't guarantee you'll get it. And he goes, I knew it. I knew there was something on the fine print. I said, listen, the only reason I can't guarantee it is because there's something in your fine print that says, oh, I'm not going to work the blueprint like I said to work the blueprint. It's not because of me. It's not because of the program. It's because of you. And I don't know you. I don't know if you're going to be like, you know what? I'm not going to follow the blueprint to the letter. I'm going to follow steps A, C, and D. And skip steps B and E, right?
That's a good one. Yeah, that's true.
So that's why I can't guarantee the results will be the same. But if I know for a fact that you will do exactly as I tell you to do, and you prove that to me, then yeah, I could guarantee it. The government won't let me say that, but I could. I said an attorney would tell me not to say it. But anyway, it was interesting. I said, if I charged you $3,000 and in the first year, you're not going to make any money because you're going to learn the craft and you're going to stick to the plan. You're going to follow it to the letter. And then the second year, you start earning $50 a month. I said, would you say that's a good investment? So the real estate investor, my buddy Mark, he's like, $50 a month, yeah. He goes, yeah. He goes, $2,400 in the second year. He goes, so divide that by 2, so that's $1,200 a year divided by my investment. He goes, yeah, I can't, the percentage is high, but I don't know exactly what it is. I'm like, exactly. It's a very good percentage, right? It's like about 30 or 40% per year if you figure it out that way. I said, and then it continues. You only get better as time goes on. You don't get worse, but even if you stayed the same, he goes, yeah, that's a good investment. The other guy, Ned, is like, $50 a month, you can't live on $50 a month. I said, great. So every time we play golf, you just give me $25 because we see each other about twice a month. Just give me $25 because $50 a month is nothing to you.
Yeah.
And Mark's like, and Mark just looked at me. He's like, you're good. You're a good salesman. I'm like, it's just from going through and seeing the scams. And now I'm in a program where I see how it works.
Yeah.
And, you know, it works. I mean, it just, is it always guaranteed to be $50 a month? No, sometimes it's $400. And then the next month it's $350 minus, right? Yeah. But you're at a net, or it's 300 minus, whatever. So you're at a net $50 a month. So anyway.
All right, you can take it away. I can see your screen, so take it away, buddy.
Okay, cool. Thanks, Travis. All right, I'm just going to cover real quick my trades from last week. Nothing's changed other than Walmart is kind of starting to drift down near. We'll see if I get a red weekly trade triangle. I haven't gotten anything yet. It's still out of the money for me, but it's only got, my Walmart trade only has 17 more days, and you can see where it's at. So, so now we're kind of treading, like I'm watching it closely now because Walmart's getting close to my in the money, and I'm looking for that red weekly. And once I see it, the other thing real quick, I forgot, Travis, I wanted to mention this. Coca-Cola, I'm in that Coca-Cola trade.
Yeah, me too.
Yeah. So Coca-Cola is another one of those stocks where you can get into it, and this is where a trade plan, I talked about trade plans before, this is where it becomes vitally important to follow your trade plan, because Coca-Cola has gone from, today it's at 26% of my credit, right? So 26% basically return on my credit, I guess is the best way you can put that. The other day it was at almost 54%, and then prior to that day, it was at a negative 12%. So Coke can be very similar to like an Apple. When you trade stocks, you're going to see this with your options. You're going to see them go from 20% return to 12% loss to 50% return to 10% loss. You'll see it just go all over the place. Without a written trade plan, you're probably going to let your emotions drive your trade, and you don't want to do that. So yeah, so I'm following my trade plan. Coke is not giving me an exit signal, so I'm not out of it. So that's it on my trade. Same with SPY. I'm not out of those trades. I haven't gotten an exit signal. And you can see I haven't seen a 50% loss on anything, so that's hasn't triggered my exit signal either. So, all right, so the next thing I wanted to just talk quickly about, a member asked about buying insurance, and this person was going to buy insurance for SPY because that's what they have. A majority of an IRA invested in is SPY. So they're looking at the 17 December 2021 options here and buying a protected put. And he was asking specifically, you know, do you buy in the money, at the money, out of the money? What do you do? So I'm just going to I'll address this in a couple different ways. So first of all, your protection is just that. It's protection. It's not designed to make you any money. As a matter of fact, you're kind of hoping that your protection expires worthless and you just wasted that money. Some people will say, that's stupid. It's like, it's not. And the example is this. If you bought SPY today at $300 a share and you bought 100 shares, that's $30,000. So your max risk of loss is $30,000. The chance of SPY going to zero is slim and remote, but the chance of it going from 300 to 150 is true, right? We've seen that in market crashes. So you'd lose $15,000. Can you stomach losing $15,000? Probably not. Can you stomach losing 2,800 if you invested 30,000? Probably. And that's what you'd lose if your investment went to zero, or if your option went to zero. You'd lose $2,800 because if you see that December 2021 costs about $2,800 if you bought it. So if you look at my screen, I got intrinsic, extrinsic values set up here. And you'll notice that if you buy at the money, it has 0 intrinsic value and it's all extrinsic. So extrinsic is your time and that's what you're paying for. Travis has done this in the past where he's bought deep in the money protected puts, and you can see when you buy a deep in the money, the true cost is that $19 right there, because you're going to get the extra or the intrinsic value back if you exercise the option. But that's the key. So in answer to your question, it really depends on what the market's doing. If I were buying my protection today for SPY, and let's say I bought SPY at, I'm just going to say 290. Let's say I bought it at 290. I could buy my protection at 290. That's all I want to do is just protect myself. But in this case, it's like, hey, my protection at 300 is a better deal. Let's pay for that in extrinsic value, and I'll earn an additional $10, right? So I would buy it here, and I'm done. I don't ever do anything with this. I don't manage it. The only thing I do is if we hit a market crash between now and December 2021, I might exercise my option to sell my shares back so I don't lose a boatload of money. But if the market keeps raging higher between now and December 2021, this thing just expires worthless. No big deal. It was just there to protect me. So Travis has done a couple things with these. He's the deep in the money. I would say that would be the avenue you take if we're starting to see that the market's definitely given us signs. We use 4 stages of a market crash, and let's say we're in stage 3, and this is the time when you're buying your insurance, let's say. Then I would look at a deep in the money, because it's most likely going to pay for itself to some extent, right? Because if the market crashes from 300 to 200, you'll most likely exercise that option to sell out of your shares and get your money back, right? So that intrinsic value would come back to you. So that the cost of it would just be that 1988. So I know that was quick. I know that seemed very brief, but that's basically how that works, how you can look at intrinsic, extrinsic value. The last thing I want to touch on real quick is open interest. The question was, hey, do you still pay attention to open interest? And I do, because open interest gives me liquidity. If I need to exercise this thing, I want to know that I can exercise this thing. But generally, I think the open interest on this particular option was at 5 yesterday or 2 days ago, and look at it today. So these things will tend to do this. You tend to see, because the option's so far out, not as many people trade really leap options. That's what these are called. So that's why you tend to see those open interests lower. But you definitely don't want to do, like, in my opinion, you don't want to do this one, because this means you're the only one in this. And if you had to sell this out, you're probably not going to. So you do want to pay attention to your open interest. Go ahead.
I'm laughing because I'm like, yeah, I literally, if you try to buy the one with 0 open interest, here's the market maker. I'm about to make some money off for somebody, man, because they control the bid and ask and what you pay for it. Like, there's nobody else buying and selling that, so they're going to literally rake you over financially. I've seen it. Ask me how I know.
Yeah, and that's a basic strategy. You guys got to understand, when we do advanced strategies, we don't get away from our basics. So we teach you guys that stuff in the basics. Open interest is important. That was a great question by one of our members when he asked about that, because typically we tend to get lazy on ETFs, especially SPY DIA, because you can almost always see thousands of open interest. But if we look at these really deep, these leap options, especially the deep in the money, you can see interest is just not there. And so you want to stay away from it. Just don't do it. The last thing I'll touch on is the out of the money. If you bought SPY at 300 and you don't want to pay $2,800 for it, and you want to just pay $2,400, I don't know why you do that, but if you did, you can go out of the money. You're just changing your risk parameters, but as long as your risk parameters don't exceed 10% of your total account, and that's really what you want to look at. You don't want to lose 10% of that total account, because that means you need an 11.1% return just to get back to break even. So you want to be mindful of your loss percentages. So going out of the money, too far out of the money, if it's going to increase your risk past 10%, then you'd want to dial that back. You want to keep within that 10% risk.
Yep.
That's it, Travis.
All right, let me ask you a question here.
Sure.
I didn't honestly want it. I never taught insurance prior to 2018, I think. And the reason why is, for example, Peter, do you have insurance on your shares that you're eventually, or will you buy insurance on your shares you're eventually going to
my
buy?
SPY? No.
Mm-hmm.
So if I'm doing the Buffett strategy, I don't, because the Buffett strategy is teaching me to buy, or it is a strategy that buys at a reduced cost. So the market has already crashed in price. I don't need protection. It's already gone through that crash and it's going to rebound. I've kind of bought, the Buffett strategy is nice because it gets us to buy on the way down, which is not intuitive for most people. That's contrary to popular beliefs. So.
Yeah, it has built-in insurance. That's my preferred blueprint.
Oh, yeah. Good point.
Because it doesn't have an extra cost. But again, my stepdad died. I was managing an account for somebody who literally can't afford to lose money. So I was like, oh, what can we do? So I started teaching this concept of buying stock insurance, which is helpful for a lot of people because it never dawned on me like, duh, not everybody's is diligent like Peter and actually following the low risk blueprints I teach. They're still on that whole buy and hold, buying at all-time highs. I was like, man, they're really about to get hurt in a market crash. And so it was helpful for them. So you have two approaches. You can, if you're on the old traditional buy and hold, hey, I'm still buying stocks at all-time highs, absolutely 1000%. It is in my not so humble opinion is that account needs to be insured. No ifs, ands, buts about it. But if you follow our low risk blueprints, no, I don't buy insurance for my Buffett strategy. I don't need to. This is built-in insurance. So anyway, I want to beat that down anymore. Are you done, Peter?
I am done. I'm going to change presenter view back to you.
Okay. I know you're on a clock, so I should be done by the time you need to go. But if not, you can just walk off and I'll just.
I won't walk off. I'll be here.
Okay. All right. So what I'm going to do before I share my screen with you, let me move this out the way. My theme for today is going to be truths about wealth building. All right. Now, before I share that, I want to continue a story I talked about in the last recap. I talked about how I damaged my body while I was in college and I became morbidly or obese. I can't remember the exact one. I don't care if you went off BMI or weight. I was super obese, right? 5'3", weighing close to probably 200 pounds, right? So what I didn't share is like, oh yeah, I forgot to tell people I had was single for 10 years, right? Hadn't had a long-term relationship in 10 years. And so I was like, well, I'm not gonna get married anytime soon. I don't have any prospects. I might as well do what I wanted to do when I was 12. I grew up in an abusive environment. When I was 12, I made a vow, crying one day. I was like, I want to help people when I grow up. I don't want people to feel the pain I feel right now as a kid. I didn't know what that meant though. So now I help people financially. So I was like, well, I'm single. I might as well serve. This is what I really want to do. I wanted to serve humanity. And so I signed up for the Peace Corps and I was just going to go away and serve. Well, fat boy here, not now, but failed, right? I got denied medically. And so I failed their medical test for various reasons, overweight, high cholesterol, all that, right? So I was sitting here cracking up the other day. I was like, I could picture somebody at the Peace Corps headquarters getting my medical results because you have to go through a medical exam. They're like, geez, he's 5'3", 200 pounds, high cholesterol. I had heart pains and all the kinds of other stuff going on. They're like, this fat boy is going to die on us in another country, and that paperwork's going to be hell. Denied. So that's what I was picturing. So that's my interesting fact for the day for Trader Travis. And last interesting fact is the beauty of that story is it had a good ending. Is the day I got the week I got denied, the week I got notification that I had got denied medically for the Peace Corps, is the week I met my wife on eHarmony. I had signed up for a dating service. She showed up in my inbox that exact same week. And we were actually their TV commercials way back in the day. In 2008, we were one of their couples that show on the TV commercials back in 2008. I don't think I'm on this page anymore, but we were on the success stories page for diversity because we're an interracial couple. So a lot of people don't know that. Travis was on my 10 seconds of fame on TV back in the day. All right. So, yeah, thanks, buddy. Now I will pull up a sheet I want to share talking about the themes of wealth building. Peter and I covered, gosh, where is it? Here it is. Peter and I talked about Trade Alert Services a while back. That's not the way to build wealth. A lot of people don't believe us. And so here's a quote from Robert Kiyosaki. I was a member of one of his programs. And in the newsletter, here's what he put. Now I'll read it to you. So this is his opinion, right? A successful guy's opinion. And he said, he was talking about this stock, Tesla, and, maybe why you should invest in this certain industry. But then he put this in here. You should use this information to think for yourself, right? Think about that. Trade Alert Services, you don't think for yourself. So keep that theme in mind. You should use this to think for yourself. Read more about lithium if that stood out to you. Read more about options if that sounds interesting, but you don't know enough. You shouldn't outsource your brain to me. Trade Alert, right? He said that's lazy, and laziness will keep you poor. Maybe I copied this wrong. That's why I'm not, or either this is a grammar. Anyway, that's why he's not telling you to invest in Tesla or to dump your money into this particular stock. I think it was like a penny stock he was covering. And then later on in the same newsletter, towards the end, this is how he ended the newsletter. If you bought this newsletter to take a shortcut and have someone else, me, do all your work free, then you need to cancel immediately, because that's just being lazy. And you know what I call a lazy investor? Poor. All right. So if you didn't believe what Peter and I said about Trade Alert Services, believe someone else. This is the truth about wealth building. This is another guy who's built wealth, and he's telling you that, hey, you shouldn't outsource your thinking to someone else. You shouldn't take shortcuts to building wealth. You should put in the work to do it yourself. Now, moving on to a total different subject here. I was going to cover this in my 10-minute income trader case study. I said I would talk about Pinterest, and then Beyond Meat. I think Pinterest is P-I-N-T, but let's do Beyond Meat. A lot of people are so infatuated with Beyond Meat, this new IPO that's gone up, I don't know, something I'm saying like 700%. Today it's down almost 10% on earnings and things like that. And I'm part of a program now too. I joined another program to get another millionaire mentor, and he was saying how nobody should be in Beyond Meat. Investors Business Daily just talked about Beyond Meat, saying, hey, you probably shouldn't be in it right now. Again, these are people I follow, people's opinions I respect. They're saying don't get into it. And the mentor, it was his class, he spent some time talking about this. He's like, I know some of you all are in this because I keep getting questions about it. And so he's trying to teach them a professional's way to invest. And a professional would wait into an ideal buying point or wait until they get earnings. Because as far as I know, they're not really making money yet. So they wait until like 3 or 4 quarters of positive earnings, because that's when the institutional investors are really going to be getting into this and getting behind this stock. Or Investors Business Daily says wait for like a pullback and a good buying opportunity. So these are professionals following a professional blueprint. They're not following greed or the sure thing syndrome. There are a lot of people who think this is a sure thing, it's going to be the next Amazon, and it may be, but we can't predict the future. But they're literally guided by greed and the sure thing syndrome. They have no kind of blueprint that they're following. So what I wanted to do is show you one of my blueprints I learned from a millionaire. I think it's here it is, PINS, Pinterest, right? Let's say Pinterest is another IPO, and you think it might be Facebook, you might think it go up. Pinterest is currently trading for $28. So if I bought 100 shares, that's $2,800. So I would not get into this stock, which is why I'm not getting into Beyond Meat, because I couldn't find a way for it to satisfy my blueprint of, if I'm going to do speculative trades, they need to be no more than 1 to 3% of my account. That's what I learned from an uber successful millionaire. If you're going to gamble, make sure it's no more than 1 to 3% of your account. Beyond Meat doesn't fit that criteria. Either the stock, well, I could buy 3% of the stock, but I don't want to do that, or the options. The options are super expensive. But PINS does in one of my accounts. So here's how I would do it. First, I could buy the stock, but I'm primarily specialized in option trading. So what I actually did in one of my accounts is I sold some stock insurance to someone. I went out as far as I could, 500 days. I sold some stock insurance here. I brought in about $800. What did I do with that $800? I turned around and then bought a call option with that $800. So my call option was risk-free. It was financed by my put. So if Pinterest does take off to the moon like Beyond Meat, I'm going to make a lot of money. But if it doesn't, guess what? I'll be assigned shares, at $30 or whatever. So I'm going to invest 3,000. But again, it's still 1% of that account, 1 to 3%, right? So if it goes to zero, am I really hurt financially? No. See, that's a blueprint. That's how you should gamble. That's how you should temper that sure thing syndrome, is you follow a blueprint so that, yeah, I'm in the game. If it takes off, I'm going to make a lot of money, and it wasn't any of my own money. How you could take this a step further is I rented out my stock shares in that same account with another stock, brought in 800, right? That was my risk capital. Then that's what I used to go ahead and said, okay, let me do this covered call. let me do this, cash security put covered calls, blah, blah, blah. In the end, that doesn't matter if the stock goes to zero or not. I'm not going to lose any of my own money. I'm going to lose money the market gave me. I'm talking fast because I know Peter has to go, but did that make sense, Peter?
Yeah, it did. And for those of you that didn't make sense, it's why you have to increase your education.
Yeah, and keep going over the training.
Yeah, if you're a student of ours, just keep going through the training. If you're not a student of ours, you've got to figure out a program that will teach you this stuff.
Yeah, and I'm circling, as Peter's talking, I'm just circling through some other stocks. I read Investors Business Daily. They had an article on the solar industry, and I was reading, I'm like, yeah, that makes sense. I'm like, okay, if I want to bet on the solar industry, right? Again, that greed, I'm like, ooh, it's going to take off. Solar industry is going to be huge. I'm like, I feel it. I'm no different than anybody else. I feel the same kind of greed. You want to just invest all of your account on this, and hope it just triples in value. But I'm like, always have to settle back, like Travis, follow your gambling blueprint. And so this is another one. It's trading for $19, so I could do the same thing I just showed you, via the options. So anyway, so let me move on there. Next, I'm switching up. So that's second truth about wealth building. First truth, quick recap. Robert Kiyosaki, in his own words, don't outsource your thinking and brain to someone else. That's intellectual laziness, he called it. Somewhere else in this newsletter, he said that makes you poor. Second truth about wealth building is, you can invest in Beyond Meat and think you're going to get rich, but that's on one stock. You're putting all your future on one stock. No, you shouldn't do that. You should follow a wealth building blueprint to gamble properly. And I don't need one stock to take me to the moon, right? That's putting all of my faith in something I don't control. That's why I have the 5-year retirement plan. I follow that, and that allowed me to, nearly quadruple my account in 2 years. I don't need Beyond Meat when I'm, following another blueprint that allows me to quadruple my account in 2 years. Third truth about wealth building is 401ks are largely a scam. Controversial, going to step on some toes, but I listened to a podcast this morning and made me think about it. I'm like, yeah, so many people don't know about this. And he was asking this guy, hey, how much do you pay in fees to your financial advisor? And the guy was like 1%. He's like, oh, it's not that much, it's 1%. And the guru, the millionaire, laughed. He's like, gosh, people really don't get millionaire math, right? And I was like, yeah, I know, right? In your brain, right, this is how people trick you. In your brain, you're thinking 1% is not that much. Let me show you 1% is a lot. So here's a simple investing calculator. You start with $2,000 in your 401k, you put $250 in it a month. Over 40 years, you earn the stock market's average of 9%. At the end of those 40 years, you have $1 million. You've seen these little scammy examples like this before. I've already talked about it. Stocks don't compound like this, but we're going to get into that. That's somewhere else in my training. So 1%. Oh, it's not that much. It's only 1%. All right, let's take this. 1% means you don't get your 9% return. You only get 8% return. Now look at this dollar figure here. 1 million. I want to hit calculate, the big reveal. Boom. $820,000. 1% is not that much. I really hope you like your financial advisor, because you just paid them over close to $200,000 to manage your account. So 1% is a lot. You might not think it's a lot, but honestly, it's not 1%, because I studied to be a financial planner. Yeah, they might charge 1% AUM, assets under management fee, but what you don't realize is they get kickbacks from the funds they recommend, maybe 0.2% here. The other funds have fees. The funds they put you in have fees, right? So it's not 1%. Your total cost. When I go to them, I say, what's my total cost all in? Because if you just ask what's my cost, they might just give you their management fee, but they don't give you your total cost, their management fee plus the fees the funds charge you and all these other miscellaneous fees. So let's say it's about 1.8%, and that's conservative, right? Super conservative because most people are getting raked over 3% a year. And I'll show you that. So let's say it was on the conservative end, 1.8%. So again, you don't get the 9% stock market average, you get 7.2% now because you have to back out your fees. Remember, we were at $1 million without fees. Now with the fees, what are you at? 600,000. Geez, they stole $400,000 of
almost
your wealth.
50%.
Yep, this is Wall Street scam. This is what they have you in 401ks. This is why they, in my theory, why they have all these rules where you can't pull out your money. They've guaranteed that they can, if you financial, I'm gonna use the word. They've guaranteed that they can screw you over financially. Yeah, I just delete that rude word out because it's gonna offend somebody. So they've guaranteed that they can screw you over financially and for fees for 40 years, and you can do nothing about it. All right. So last thing, 401ks, in my opinion, are largely a big scam for those two reasons: fees and taxes. I didn't talk about taxes, but let's just show you here real quick. Well, I'm going to show you the notepad. Okay, I'll just show you here my calculator. All right. So people are like, oh, Travis, but you don't get the tax deduction. Okay. Well, I put my 10 grand in a Roth or regular brokerage account. You know, it's after tax money, which meant I paid taxes on that 10 grand. And what I have left is $10,000. Okay. But in my Roth, it's going to grow, right? And when I pull it out, I trade options. It's going to grow to $1 million, right? Hands down. When I pull it out, I don't pay taxes on that $1 million. It's in my Roth, right? You're like, oh, I got my tax deduction. Yeah, you got a tax deduction on 10 grand, right? On a small balance. Guess what? If yours grow to $1 million, which it won't, because I just showed you why, because of fees. But let's say, real life example, yours is going to grow. Oh, I didn't show you the 3% example, but you can imagine if I just showed you 1.8, you see how much you cut from your $1 million. Imagine what 3% is. But anyway, at the end of your 401k is going to be about 600,000. You got a tax deduction, but you got a tax deduction on 10 grand. You have to pay taxes on 600 grand. So I was like, what would you rather pay taxes on, 600 grand or 10 grand? See, this is the truth about wealth building that people don't teach you. They trick you and seduce you with all their marketing, and you think, oh, tax deductions are great. Yes, you got a tax deduction on 10 grand, but they're going to make more money off of you because you're going to pay taxes on 600 grand. Me, I'm like, nah, I want to pay taxes on a smaller balance so I can keep the bigger balance in my pocket. That's all I have for you. I talked way too long, but I hope it gave some aha moments and brilliant tips. Go for it, Peter.
I was just going to say, I wrote an article about 401ks at jpcashflow.com, which if you guys check it out, it's a really good article. I did all the math on this because what most people don't realize is when they have $1 million or $800,000 in their 401k, they're like, all right, I have 800 grand. And it's like, no, you have about half of that because that's about what you're going to pay in taxes. And most people will argue with me and they'll say, well, Travis, I'm not going to pay taxes on 600,000 because I won't withdraw 600,000. It's like, oh, guess what? There's a caveat that says at 69.5, you will withdraw 10%. And 10% of 600,000 is $66,000. So now do the taxes on $66,000. And the last point I'll make, do you think taxes are going to be lower in the future or higher in the future? All you have to do is look how the government spends money, and you know they'll be higher. So,
yep. Amen to that. I 1,000% agree.
So that's it. That's all I wanted to add in there. So,
all right.
Ruby.
Y'all take care. Hope you enjoyed this recap. See you next week. All right. Bye-bye.